At Value Focused, we believe an informed investor is a protected investor. Everything you are about to watch is based entirely on Securities and Exchange Board of India publicly filed interim order dated June 3, 2026, audited financial filings, and verified reports. This is an educational deep dive, not a recommendation to buy, sell, or take any position in this or any other security. The investigation covered in this documentary is ongoing. No final verdict has been delivered. Value Focused and its creators do not take any position on the guilt or innocence of any individual or entity named. Always conduct your own due diligence. Consult your financial advisor before making investment decisions. We are a financial education institution. We are here to teach you how to think. Imagine a company that started with nothing more than a small jewelry export counter in Bengaluru. A family business, simple, honest, hardworking. Now imagine that same company 3 decades later, reporting revenues so large, they make the combined exports of entire Indian industries look like pocket change. 15.45 lakh crore rupees in just 5 years. That number is not a mistake. That is not a misprint. That is more than 20% of India's total annual export value. It is larger than the GDP of entire nations. And on the 3rd of June, 2026, India's top market regulator, Securities and Exchange Board of India, looked at those numbers and used 4 words that have never been used in Indian corporate history before. Egregious and unheard of. Shares crashed. Billions evaporated. Retail investors watched their savings vanish. LIC, holding your policy premiums, was sitting on a 10.8% stake. And the question that is shaking every serious investor in India right now is this: was it all real? Or was one of India's biggest corporate empires built on air? This is the full story of Rajesh Exports. Before we go in, here is your roadmap for this documentary. Chapter 1, The Rise. Chapter 2, The Numbers That Broke the Internet. Chapter 3, The Swiss Illusion. Chapter 4, The Phantom Partner. Chapter 5, The Personal Accounts. Chapter 6, The Fallout and the Defense. Chapter 7, The Value-Focused Framework. If this kind of deep dive market investigation is new to you, subscribe right now and hit the bell icon on YouTube. I put out content like this every single week. And if you are watching on any other platform, follow Value Focused. You do not want to miss what comes next. Now, let us begin. The year is 1989. Rajesh and Prashant Mehta are 2 brothers from Bengaluru, with a dream that most people at the time would have called ordinary. They want to export gold jewelry. No private equity, no venture capital, no Silicon Valley hype. Just 2 brothers, a workshop, and the grinding discipline that only a family business can teach you. For years, they built slowly, exporting jewelry, building relationships, learning the craft of gold, not just as a metal, but as a global commodity with its own rules, its own risks, and its own ruthless economics. And they were good at it. By the early 2000s, Rajesh Exports Limited is a listed company on the Indian stock exchanges. They are growing, they are expanding, they launched their own retail jewelry brand, Shubh Jewelers, bringing gold directly to the Indian consumer. The dream is getting bigger. But the moment that changed everything happened in 2015. In 2015, Rajesh Exports made a move that stunned the global precious metals industry. They announced the acquisition of Valcambi SA. Now, who is Valcambi? Valcambi SA is a precious metals refinery located in Bellerna, Switzerland. And not just any refinery. It is one of the largest and most respected gold refineries on the planet. They produce those iconic gold bars that central banks hold in their vaults. And Rajesh Exports bought it for approximately $400 million. Think about what that means. A family business from Bengaluru, in one bold stroke, went from being an Indian exporter to controlling the entire gold value chain, from mining inputs to refining in Switzerland to retail in India. It was an end-to-end gold empire, The market loved it. The stock soared, revenues climbed, institutional investors poured in. LIC accumulated a 10.8% stake. The stock hit highs near 1,000 rupees. And whenever anyone asked, how does a single company produce these numbers? The answer was always the same. Gold refining is a high-volume, ultra-thin margin business. The gross flows are enormous. The profit is tiny. Don't be confused by the revenue. Look at the margins. It was a reasonable explanation, and for years, everyone accepted it. Until one retail investor looked a little harder. And what that one retail investor found in March 2024, a single unpaid bill would crack open a 15 lakh crore rupees empire. In corporate finance, there is a line item called trade receivables. It simply means money that customers owe you for goods already delivered. In the gold business, these are typically settled fast. Gold does not sit on credit for long. The entire industry runs on speed and trust. So when a retail shareholder of Rajesh Exports looked at the company's balance sheet in early 2024 and saw a massive pile of trade receivables from overseas buyers that had been sitting completely unpaid for over 2 years, he asked a simple question: why would gold customers not pay for 2 years? He filed a formal complaint, and in October 2024, board launched a formal investigation. Board appointed BDO India as forensic auditors, and that is where this story turns into something that even the most seasoned market veterans did not see coming. When BDO India asked for basic access to Rajesh Exports' internal accounting system, the ERP software, journal entries, the company said no. Their reason: Swiss data protection laws. The board pushed back hard. In their 109-page order, they explicitly tore apart that argument. Swiss data protection laws protect human privacy, not corporate accounting from regulators. When Securities and Exchange Board of India bypassed the parent company and looked directly at records, they found a black hole, and that black hole has a number: 15.15 lakh crore rupees. You are probably wondering right now, how on earth do you hide 15 lakh crore rupees? The answer is simpler than you think, and it starts in the mountains of Switzerland. Let me give you the single most important number in this entire documentary. The number is 550. 550 times. Here is what I mean. Securities Board Forensic Investigation pulled 2 sets of numbers for Valcambi SA, the Swiss refinery at the heart of this empire. Set number 1, Valcambi's own independently audited accounts, audited by KPMG in Switzerland. Valcambi SA, KPMG audited local revenue was 3,027 crore rupees from FY 21 to FY 25, 5 years. And Rajesh Exports reported to Indian investors 15,184,113 crore rupees for the same entity and same period. The gap, 550 times. How does a company explain a 15 lakh crore gap? They said Valcambi only records processing fees locally. The actual gold value was being booked by a different entity altogether, a holding company called Global Gold Refineries AG, or GGR. Global Gold Refineries AG is a holding company with 0 physical operations, no refinery, no warehouse, no staff of any meaningful size, no infrastructure. Global Gold Refineries AG is a holding company with 0 physical operations, no refinery, no warehouse, no staff of any meaningful size, no infrastructure, just a corporate shell sitting in the middle of the structure, allegedly booking hundreds of billions in gold that it had no physical capacity to handle. Securities Board's conclusion was straightforward. The transaction trails for these revenues simply do not exist. Not missing due to complexity, not lost in translation, they do not exist. But the Swiss illusion was only one piece. Back here in India, investigators found something even stranger. A company that claims Rajesh Exports never existed as a business partner. 11,000 crore of transactions completely denied, under oath. In corporate accounting, There is a concept called reconciliation. If Company A says they sold 100 crore rupees to Company B, then Company B's books must show a 100 crore rupees purchase. The numbers must mirror each other. According to board's order, Rajesh Exports books showed over 11,487 crore rupees in sales to an Indian entity called Affluence Shares and Stocks Private Limited, and 11,488 crore rupees in purchases from the same entity, nearly identical numbers, flowing in two directions, almost perfectly cancelling each other out. So board went to Affluence Shares. And Affluence Shares, under oath, completely denied the transactions. They stated that no such multi-billion crore business relationship ever existed. One company claims 11,000 crore rupees. The other says, "We don't know you." Investigators noted this as a textbook pattern: artificial turnover inflation, the creation of a paper trading loop to manufacture the appearance of a large, thriving business on paper. But where was the money going? Board's interim order alleges that approximately 339 crore rupees of company funds, your money, were routed out of corporate accounts and directly into the personal accounts of Chairman Rajesh Mehta. Not through a board-approved loan, not through a disclosed related party transaction, directly into personal accounts. And the regulator found that 7.4 crore rupees were used personally to trade in high-risk F&O. Some of the funds were reportedly returned later, but that is not the point. The point is, 339 crore rupees moved without a paper trail, without governance, and without the knowledge of public shareholders. The immediate consequences of board's June 3rd order were swift and brutal. Rajesh Exports shares hit lower circuit day after day. Wealth destruction estimated at over 12,726 crore rupees. Canara Bank, which held 509 crore rupees in debt exposure to Rajesh Exports, classified the account as a stressed asset and announced plans to auction the debt. And then there is LIC, the Life Insurance Corporation of India, sitting on a 10.8% stake, watched hundreds of crores of policyholder money evaporate in real time. Retail investors, small investors who trusted the story, who held this stock in their portfolios, lost capital they may never recover. The human cost of corporate governance failures is never abstract. It is always someone's retirement savings, someone's child's education fund, someone's dream. Now let's look at the defense. Rajesh Mehta has denied every allegation. His argument: first, this is an interim order without hearing their side. Second, the revenue gap is an accounting treatment difference, not fraud. Third, the Swiss documentation barrier was a genuine legal challenge, not stonewalling. He has promised exhaustive documentation within the regulatory deadline. So, is he right? Is this a massive misunderstanding? Possibly. But when your own counterparty denies the transaction ever happened, under oath, that is not a documentation gap. That is a factual denial. When corporate funds move to a personal account for personal derivative trading, that is not a technicality. And when auditors cannot access ERP records for years, that is not Swiss law. That is a choice. The truth is, we do not know the final verdict yet, but we know enough to ask the right questions. Before I give you the final chapter, here are the 5 lessons this story burns into your DNA. Lesson 1. Consolidated revenue is not verified revenue. Lesson 2. Always compare consolidated numbers with standalone. If the gap is astronomical and opaque, demand explanation. Lesson 3. Aged trade receivables are a red flag. Lesson 4. Question related party transactions with shell companies. Lesson 5. Regulatory orders are early warnings, not convictions, but not noise. Now here is the part that no news channel will give you. The red flags in Rajesh Exports were not hidden in a 109-page order. They were hiding in plain sight, in publicly available data that any investor with an internet connection and a trained eye could have accessed. At Value Focused, we teach one principle: The balance sheet does not lie, but it does hide. Your job as an investor is to make it confess. Here is the framework that would have flagged this years ago. Signal 1. The cash flow versus revenue gap. Rajesh Exports reported 4 lakh crore rupees in revenue, but in a legitimate business, operating cash flow should roughly track revenue over time. When a company reports massive revenue but negative cash flow, it is not generating real money, it is generating paper entries. The check. Divide operating cash flow by revenue. If it's near zero, alarm bell. Signal 2. The trade receivables aging trap. This is the exact signal that one retail investor used to crack open this case. Gold is cash. Pharmaceuticals move in 60 to 90 days. IT services bill monthly. Every industry has a natural collection cycle. When trade receivables from overseas buyers keep growing year after year and are not being collected for 12, 18, or 24 months, there are only two explanations. Either the customers cannot pay, or the transactions were never real. The check. In the annual report, note 8 or 9, look for the aging schedule. If you see large amounts more than 6 months overdue, investigate before you invest. Signal 3. The consolidated versus standalone mismatch. In Rajesh Exports, the Indian business was modest. The extraordinary numbers came from overseas subsidiaries that auditors couldn't verify. The check. If consolidated revenue is more than 3 to 4 times the standalone, and the difference cannot be explained by named, verifiable, audited subsidiaries, that is a structural risk you must price in. Signal 4. The promoter shareholding and pledge pattern. A promoter who truly believes in his company's future does not pledge his shares unless he absolutely must. High and growing promoter pledge percentages are a sign that the promoter is borrowing money against his own equity, often because he cannot get institutional credit on the strength of the business alone. In Rajesh Exports, the alleged diversion of corporate funds to personal trading accounts raises a deeper question. Was the promoter under personal financial stress that the company's public image was hiding? The check. On BSE or NSE, search the company name and click on Shareholding Pattern. Under Promoter Holdings, look for the pledged percentage. Any pledge above 30% of promoter holdings warrants serious scrutiny. Rising pledge over consecutive quarters is a severe red flag. Signal 5. The auditor. Quality and continuity check. In Rajesh Exports, board has referred the matter to NFRA, the National Financial Reporting Authority, to investigate the company's past auditors. The auditor is the last independent line of defense between a promoter and the public investor. When that line is compromised or simply incompetent, the investor has no protection. The check. 3 questions to ask about any company's auditor. 1. Is it a Big Four or a recognized mid-tier firm? A small unknown auditor signing off on lakh crore revenues is a red flag. 2. Has the auditor been changed recently without a clear, disclosed reason? Auditor exits midterm are one of the most underreported warning signals in Indian markets. 3. Has the auditor issued any qualifications or emphasis of matter paragraphs in the audit report? These paragraphs are the auditor's way of quietly telling you something is wrong. Signal 6. The gross revenue business model red flag. When a company claims to be in a thin margin business, gold refining, commodity trading, bullion, but reports gross revenue instead of net revenue or value-add revenue, the absolute number becomes meaningless. A company booking 4 lakh crore rupees in gold that simply passes through its books at a 0.1% margin is a logistics company, not an empire. The stock market should not value it like an empire. The check. Divide net profit by total revenue. If the net margin is consistently below 0.5% across multiple years on a massive revenue base, question the business model. Is this company creating real economic value, or is it simply a conduit inflating its gross flows to look larger than it is? So, 6 signals to check before you invest. Cash flow versus revenue. Does the company actually collect cash at scale? Trade receivables. Aging. Are customers paying on time for the industry? Consolidated versus standalone. Where is the big number actually coming from? Promoter pledge percent. Is the promoter confident enough to keep his shares unencumbered? Auditor quality and continuity. Who is signing off and are they independent? Gross versus net revenue model. Is this company creating value or just passing volume? These 6 checks take less than 30 minutes on any company. They use only publicly available Securities and Exchange Board of India mandated disclosures. No insider information. No tips. No analyst reports. Just you, a listed company's annual report, and the discipline to ask uncomfortable questions before the regulator has to. This is what financial education actually means. This is value-focused. The forensic audit is ongoing. NFRA is investigating the auditors. The company has 30 days to respond. The final verdict has not been written, but the market has already spoken, and 12,726 crore rupees of investor wealth has already vanished. Here is the cold, hard truth about the stock market that this story teaches us better than any textbook ever could. A glossy balance sheet is not proof of wealth. It is a claim, and claims must be verified. Always. The man who verifies those claims is not your broker, not the company's PR department, not a bullish analyst on TV. It is you, the investor, armed with information, skepticism, and the discipline to ask uncomfortable questions. So I ask you, what do you think? Is Rajesh Mehta going to walk back in with 30 days of documentation and prove 15 lakh crore of real gold transactions? Or is this the final chapter of a glittering empire that was always more story than substance? Drop your verdict in the comments right now. I genuinely want to know what you think. If this documentary gave you clarity, gave you knowledge, gave you something to think about, share it with one investor you know. Not 10, just one. The one person who needs to see this. If you got real value from this, subscribe and turn on notifications. I drop content like this every single week. And if you are watching on any other platform, follow Value Focused. You never miss a story like this when you follow. See you in the next one. This documentary is based on publicly available information, including Securities and Exchange Board of India's interim order dated June 3rd, 2026, audited financial filings, and verified reports. The investigation is ongoing. No final verdict has been delivered. Value Focused and its creators do not take any position on the guilt or innocence of any individual or entity. This content is for financial education only. Always conduct your own due diligence. Consult your financial advisor before making investment decisions.